Dhiraj Agarwal is with us, Managing Director at Ambit Investment Managers. Dhiraj, good to have you with us here. Thank you very much. Since the market is not doing very much here, I think it gives us the opportunity maybe to indulge in some, outside the market box conversation. So let's start. How do you? I mean, of course, I'm sure you've been following what's happened in the last 12 hours. This bromance between Trump and Musk coming to an abrupt, sharp halt. But from a policy, and I'm sure there are implications, right? I mean, because it's not a typical White House. They're trying to do a lot of things which have not been done for the last 30, 40, 50 years.
That's right.
So, in that sense, how do you assess? I mean, will this lead to a weaker administration? Does it, in a way, does it strengthen the hands of trading partners it's trying to put pressure on? And specifically for India, if you have any thoughts.
So the one clear thing which comes out of what is happening internationally, especially in the US at this point of time, is the uncertainty quotient has risen, right? So as you rightly said, it's almost impossible to predict what will happen tomorrow, what will happen next week, what will happen the month after that. Because you can't even price in or you can't even build your business strategy basis an announcement which came last Friday, because it could change the next Friday, right? So it's pointless. I mean, all of us go back to Excel sheets and say, okay, gainers, losers, this is how businesses will have to rejig. This is what we will have to do to readjust to the, let's say, for example, new tariff rules. But then the tariff rules changes in a week or 2 weeks time. So you can't really budget for it. So unfortunately, the one casualty which happens whenever uncertainty rises is capital spending. Most people tend to hold back saying, since we don't know what the next year or two will hold for us, since we don't know what kind of policy regime to work with, let us just postpone capital spending for a while. And that has its own feed-through effect in the economies in terms of slowdown. So and also the risk premiums come off because people want to become a little bit more risk averse. Now that's at the broad level, I think what the global picture should look like over the next year or two. Having said that, our markets look very different at this point of time. There's a full-on risk on at this point. The riskiest part of the market and the highest beta and highest momentum part of the market is actually doing significantly better as compared to the so-called safe and high-quality part of the market, at least in the last 1 month. And as you pointed out on the show a little while ago, quite a few stocks are up 40, 50, 70, 80% in just 4 to 8 weeks' time. I think that has got to do a little bit with where there is increased optimism with respect to earnings growth coming through, if not immediately, at least from a 3 to 5 year horizon. That is point one. And point two is our markets, and I've been saying this for, and I think I mentioned this on your channel once or twice. Retail has become the price setter and institutions have become the price takers. And that's a segment retail money wants to play in. And that's what is being driven. So last point on the macro front, this is definitely an opportunity for India. Because another thing which is clear is that everybody is looking at alternate supply chains, China plus one, etc., etc. And this time we have to seize it. I mean, that's the biggest point I want to make. This time we will have to capture the opportunity with both our hands, because we missed it in 2008-9 when a similar opportunity presented itself. So I'm hoping this time we will actually be able to capitalize on the opportunity.
Yeah, well, let's see. There's a lot going on. And we need to see if we can just keep walking our path, whether it's manufacturing, whether it's Make in India, or self-reliance in areas like chemicals and defense, so on and so forth. Good to have you on, Dhiraj. I was just, while you were speaking, I was also counting the number of trading days the market has been testing traders' patience. Right. And it's 15 to 16 trading sessions where we have been doing nothing. We're in a 500-point band, 24,450 on the downside, 25,100 thereabouts on the upside. Typically these long periods of consolidation, I mean, they are followed by a big move, either on the upside or the downside. I know maybe an unfair question, but what do you think? Higher chances of an upside breakout whenever this ends, or a downside one?
I think the range trading with a slight upward bias can continue for many months. And I'm actually sensing a huge similarity in the market right now as compared to what happened between Jan to May 2024. Backdrop is very similar. November, December 23, markets went up about 12 or 13%. Jan to May 24, if you actually plot the Nifty chart, it's literally like this. So point to point, in those 5 months, Nifty was up just 3.5%. But you would see, if you actually look at the internals, you would see 4% up, 3% down, 5% up, 4.5% down. Innumerable number of times, broadly trading the same range. But within that, the kind of stocks which are doing well, those kind of names actually went up 40, 50 to 80% in that 5-month time horizon. And I see something similar happening. So I'm not very hopeful that the market will break out of this range. I mean, it could break out a little bit and go another 200-300 points higher, but that's okay. I mean, I don't see a huge move on either side at the Nifty level in the next few months.
Okay, all right. Hi, Dhiraj. The big cue that we're looking at for today is going to be the RBI governor. 25 basis points appears it's baked in. And maybe that good GDP number that we got, could be one of the excuses they give that not going with 50 basis points. We'll have to see how that goes. But in a rate cooling off cycle, what is the top theme that you'll play? NBFC as well, they'll have some part of their borrowing mix that comes in from banks, so they'll benefit in cooling interest rate scenario. Could have the real estate pack as well, or maybe some of these, companies that have larger debt in their books. How would you play this rate cutting cycle?
So, I mean, real estate is an obvious one, and real estate demand has been looking pretty strong in the last few quarters, last few months as well. I mean, all the data coming out is quite strong. NBFCs do benefit, but remember, most of the NBFCs are trading at valuations from where I don't know if there are large upsides left anymore. So, I mean, that's another large conundrum in the market at this point of time. If you pick any sector or stock which is actually doing well, where there's high degree of margin of safety or high degree of predictability of earnings, there is a discomfort on the valuations. And if you go down a couple of layers where you can find some ideas, there is a discomfort on fundamentals. So one of my friends and colleagues, not colleagues, one of my friends, and a very senior fund manager once told me recently in a conversation that I've never seen a market which is so priced to perfection. That it's very difficult to find a decent quality asset which is offering you that mispriced opportunity of making some easy returns. And which is what you're seeing reflected in the Nifty, right? I mean, it's just not able to break the range because there isn't enough for it going at the mega cap, large cap, high quality stocks level for it to break the range.
Dhiraj, the issue then is, I mean, this kind of a market for the average retail investors, when the DIY retail investors, it also starts getting frustrating, right? Because it gets harder and harder to find the stocks that will do the 20-30% in a trading market, in a ranging market rather. What do you think of, the current stories that have run, still continue to run in parts? For instance, defense. I mean, that whole valuation argument can probably be tossed out of the window. But then, again, it's that situation that people find themselves in. What do I buy? Because where valuations are maybe comforting, like FMCG, stocks are not moving. And then the ones that are moving, like a Cochin or the whole defense pack, I mean, the numbers perhaps don't make sense at some level. But what's your thought?
See, it's a difficult call from 2 points of view. I mean, it's very difficult to justify fundamentally why this stock should continue to go up from here. But why is it a difficult call to say that don't buy or sell them here is because it can go higher, right? And that's a very weird kind of a conundrum. And I can explain that only by drawing parallels from the history. So, and my favorite example for that is September, October 99. I mean, one of my most revered fund manager, Prashant Jain, HDFC Mutual Fund, September, October 99, he brought his IT holdings down to zero. Now, Wipro was trading at probably 125, 150 times PE multiple at that point of time, or 100 times PE multiple at that point of time, I don't remember. But between September 99 and March 2000, that's just 6 months. 6 months, Wipro went up 4.5 to 5 times. And I mean, it's just illogical, but it went up 5 times. So somebody who's playing it, somebody who was smart enough actually to exit close to the top, there was a lot of money to be made. But could you fundamentally explain it? Could you fundamentally explain even a good quality company like Wipro trading at 600 times P multiple? I don't think so. So these things can happen in the market, and hence it's very difficult call to say the current momentum names can't go up 20, 30, 40, 50% more. But in a number of areas, I would just warn that if you're riding the tiger, be ready to jump off at the first sign of trouble. Otherwise, the pain after that could be really bad.
Okay.
A clear, unforgettable riding the tiger quote, you guys.
Oh, we can, Mr. Ramalinga Raju, who can ever forget? Yeah, reading that press release out. I mean, yeah.
But, very briefly, is buying defense stocks here akin to riding the tiger? Quickly?
I think they are expensive. I don't think they're in a bubble yet.
Okay.
Maybe not yet, but could it become at some point of time, looking at the positive momentum? Perhaps.
This is good. Ride the tiger carefully. That's the key takeaway. We got it. Thank you for that, Dhiraj.
Okay.
Okay. All right, Dhiraj. Thanks a lot for that. By the way,